Welcome to the Slight Consulting Internal Training Program on UAE E-Invoice reporting scenarios. Over the next 36 slides, we will work through every scenario you need to know, 16 in total covering tax invoices, the commercial invoice, and credit notes. For each scenario, we will cover the rules, the mandatory invoice fields, and the common compliance mistakes, then bring it to life with 3 real-world UAE industry examples. Whether you are handling standard B2B supplies, navigating reverse charge on imported services, or unwinding a self-billed transaction with a credit note, this deck is your reference. Let us begin. Before we dive in, a quick word on how this deck is organized. The 16 scenarios fall into 3 groups: 12 tax invoice subtypes, 1 commercial invoice, and 3 credit notes. Each scenario gets 2 slides. The first walks through the rules, mandatory invoice fields, and common compliance mistakes, your reference for what to do and what to avoid. The second brings it to life with 3 real-world examples spanning construction, oil and gas, retail, hospitality, healthcare, real estate, logistics, and professional services. Every slide carries a full narration script in the notes panel. Read it directly, no need to ad-lib. Let us start with Part 1, the tax invoice family. Welcome to Part 1, the tax invoice family. Tax invoices are by far the largest group, with 12 distinct subtypes covering everything from standard B2B supplies and reverse charge transactions through to specialist treatments like the margin scheme and self-billing. We will work through them in sequence. Scenarios 1 through 12, and Scenario 13, the commercial invoice, follows in Part 2. For each, you will come away knowing when to use it, what fields are mandatory, and where businesses most often slip up. Let us start with Scenario 1, the default scenario for almost every taxable supply in the UAE. Scenario 1 is the standard tax invoice, your default for any ordinary B2B taxable supply between 2 VAT-registered businesses on the UAE mainland, charged at 5% VAT. Both supplier and buyer TRNs are mandatory. By volume, this is the most frequent scenario you will encounter: routine commerce. Goods, services, professional fees, everything. The mandatory fields are unambiguous. Both TRNs, a unique invoice number, issue date, supply date if it differs, line item descriptions, unit price, quantity, VAT at 5% per line, and totals. The ASP handles validation, digital signing, routing to the buyer, and simultaneous tax data dispatched to the FTA. Common mistakes: missing the buyer TRN. Using standard when reverse charge applies for imported services. Omitting the supply date when it differs from issue date. And critically, showing VAT only as a footer total. The FTA requires line-level VAT. Let us see this play out in practice. 3 industries, same standard scenario. First, professional services. A Dubai consultancy invoices a UAE telecom for a 500,000 dirham strategy project, plus 25,000 VAT. Both TRNs shown, transmitted within 14 days. The telecom recovers input VAT in the same period. Second, construction. A Sharjah steel supplier delivers rebar to an Abu Dhabi contractor. A monthly consolidated standard invoice of 2.3 million dirhams plus 115,000 VAT, with each delivery listed by supply date. Third, retail wholesale. A Jebel Ali distributor supplies a hypermarket VAT group with 180,000 dirhams of groceries. Standard-rated and zero-rated items on separate lines, each with its own rate. 3 sectors, same pattern. Mainland to mainland, both registered, default treatment. Now let us move to something more nuanced: reverse charge. Scenario 2 is reverse charge, and this is where the VAT liability shifts to the recipient rather than sitting with the supplier. 2 triggers. First, imported services from any overseas non-resident supplier into a UAE VAT-registered business. Second, specific domestic commodities between registered dealers, gold and diamonds, precious metals and stones, and certain electronic devices under cabinet decision. In both cases, the buyer self-accounts for 5% output VAT and claims it as input VAT in the same return period. Net cash impact: 0. Reporting obligation: real. The key on the invoice: VAT is shown as 0 at line level, but the reverse charge flag is mandatory in the .AE XML. And this is the critical distinction from zero-rated. Reverse charge is not no tax. It is tax owed by the buyer, not the supplier. An unmarked zero VAT invoice will be treated as out of scope, creating compliance gaps on both sides. Examples next. 3 industries where reverse charge is a daily reality. First, oil and gas. An Abu Dhabi oil company engages a UK reservoir engineering firm for 3 million dirhams of seismic analysis. The UK firm issues a GBP invoice with no UAE VAT. The UAE oil company self-accounts for 150,000 output VAT and recovers it in the same return. Net cash zero, reporting real. Second, jewelry. A Dubai gold refinery sells 10 kilos of investment-grade bullion to a registered manufacturer. Gold between dealers is a reverse charge commodity. The invoice shows zero VAT with the reverse charge flag and commodity code. The manufacturer self-accounts. Third, technology. A financial services firm pays AWS $220,000 for cloud services. AWS has no UAE TRN, so reverse charge applies, roughly 40,000 dirhams self-assessed each year. This pattern repeats for every overseas SaaS subscription, a significant annual liability that requires systematic tracking. On to zero-rated supplies. Scenario 3 is zero-rated, taxable at 0%, but crucially with full input VAT recovery on related costs. That makes it sharply different from exempt, which we will come back to in a moment. Zero rating covers exports of goods with customs evidence within 14 days, international transport of passengers and freight leaving the UAE, qualifying healthcare and education at licensed facilities, investment-grade precious metals at 99% purity or above, and the first supply of newly constructed residential buildings. The zero rate must be stated explicitly on the invoice, not left blank. Together with the basis, export, healthcare, international transport, and so on. Supporting evidence is mandatory. Without it, the FTA reclassifies the supply as 5% and recovers tax plus penalties. And the vital distinction: zero-rated lets you recover input VAT. Exempt does not. Out of scope does not. Confusing these 3 categories has material, sometimes multi-million dirham, financial consequences. Industry examples next. 3 sectors where zero rating applies and evidence discipline matters. First, healthcare. A Dubai private hospital performs a qualifying surgery for 280,000 dirhams at 0% VAT. The zero rate is stated explicitly. FTA qualification documentation is on file. The hospital recovers input VAT on medical equipment, consumables, and utilities, the key advantage of zero-rated over exempt status. Second, logistics. A freight forwarder moves cargo from Jebel Ali to Oman, 95,000 dirhams at 0%. Customs export declarations and bills of lading are retained as mandatory audit evidence. Miss the evidence and the FTA reclassifies the entire supply as 5%, a 4,750 dirham liability plus penalties. Third, precious metals. A DMCC-registered trader sells 5 kilos of 99.9 gold bars to a UAE bank for 1.5 million dirhams at 0%. The assay certificate confirming purity is the evidence. Below the purity threshold, treatment changes completely. Up next, deemed supply. Scenario 4 is deemed supply, a supply for VAT purposes where no money changes hands. For triggers: first, business gifts to a single recipient exceeding 500 dirhams in any 12-month period, the full value, not just the excess. Second, private or non-business use of business assets by the owner, employees, or anyone else. Third, commercial free samples above the same threshold. Fourth, and most expensive, assets on hand at VAT deregistration where input VAT was previously recovered. In all cases, VAT is due at 5% on fair market value at the time of the deemed supply. The supplier raises a self-issued tax invoice, documents the FMV basis, and bears the VAT from its own funds. There is no recovery mechanism. Businesses overlook this because it feels internal. The most commonly missed triggers: corporate gifting at Eid and National Day, staff use of company vehicles, private use of company apartments, and asset disposals at deregistration. Examples next. 3 real-world deemed supply triggers. First, hospitality. A hotel group gifts 800 dirham luxury Eid hampers to 200 corporate clients. Each gift exceeds the 500 threshold, so the full 800 per recipient is deemed, not the 300 excess. Total deemed supply 160,000 dirhams. VAT liability 8,000, borne by the hotel. The gift log is essential. Without it, the FTA at audit assumes the entire program exceeds the threshold. Second, real estate. A developer's furnished Dubai Marina apartment is used by the CEO for 8 months as a personal residence. Fair market value of 8 months rental, 180,000. VAT liability, 9,000. This is one of the most common findings in FTA audits of property developers. Third, manufacturing. A furniture company deregisters with 2.25 million dirhams of assets on hand, raw materials, finished goods, plant and machinery. Total VAT liability, 112,500. Missing this is the most expensive deregistration mistake. On to disclosed agent billing. Scenario 5 is disclosed agent billing. An agent issues a tax invoice on behalf of, and in the name of, the principal. The legal effect. The supply belongs to the principal. Principal's TRN, principal's VAT liability, principal's supply characterization. The agent's commission is treated as a completely separate taxable supply. You see this everywhere. Property managers billing tenants on behalf of landlords. OTAs billing guests on behalf of hotels. Advertising agencies billing clients on behalf of media principals. Marketplace platforms billing on behalf of merchant sellers. The invoice must carry the principal's TRN as legal supplier, the agent's TRN and name as disclosed issuer, the buyer's TRN, the disclosed agent scenario code, and a clear statement that the agent issues on behalf of the named principal. A written agency agreement must exist before any invoices are issued. Get the structure wrong, agent's TRN as supplier, and the buyer's input VAT claim can be challenged at FTA audit. Examples next. 3 industries where agent invoicing is structurally embedded. First, real estate. A Dubai property manager handles 120 units for 30 landlords. Rent invoices to tenants carry each landlord's TRN, with the manager identified as the disclosed agent. The 5% management fee is invoiced separately under the manager's own TRN. Tenants recover input VAT using the landlord's TRN, which only works if the structure is correct. Second, travel. An OTA sells hotel rooms to a corporate travel account. The hotel is the principal. The OTA is the disclosed agent. The hotel accounts for VAT on the room rate. The OTA accounts for VAT on its booking commission separately. Corporate travelers recover input VAT using the hotel's TRN, making disclosed agent invoicing commercially valuable, not just a compliance requirement. Third, advertising. An agency places 5 million dirhams of digital ads for an FMCG brand. The brand's TRN appears as principal. The agency is the disclosed issuer. Without this structure, the brand spend appears as the agency's cost in FTA data, a systematic mismatch. On to summary tax invoices. Scenario 6 is the summary tax invoice. One periodic invoice consolidating multiple supplies to the same VAT-registered recipient within a single tax period. Each underlying supply is listed with its own supply date and value. VAT is cumulated at the end. Suited to utilities billing multiple metered events monthly, telecoms with detailed call and data records, recurring FM and maintenance contracts, and frequent goods deliveries under standing orders. The summary invoice replaces individual invoices for each delivery or service event. Mandatory fields, both TRNs, summary invoice number, issue date at end of period, supply date for each line, that is the critical one, net value per line, cumulative VAT, total gross, and the period covered. Different VAT rates need separate lines with their rates clearly stated. Here is the critical compliance rule. Each line's supply date controls which VAT period that supply belongs to. A summary invoice issued in February for January supplies still reports those supplies in the January return. The summary does not defer reporting, and trying to straddle a period boundary risks penalties. Examples next. 3 high-frequency supply relationships using summary billing. First, utilities. DUA provides electricity and water to a commercial tower throughout January. Rather than hundreds of micro-invoices, one monthly summary tax invoice, each weekly metering period listed with date, quantity, tariff, and line VAT at 5%. Both TRNs present. Supply date per line equals the end of each metering period. One invoice to process, fully itemized and auditable. Second, telecoms. A corporate client receives voice, data, and connectivity across 50 UAE offices. Thousands of usage events monthly become one summary invoice. The ASP's structured Pint AE data lets the client auto-match invoice lines against internal cost center allocations. Third, facilities management. An FM company at a DIFC complex bills daily cleaning, weekly maintenance, and 24/7 security under a 3-year contract. One monthly summary tax invoice, cleaning completions, maintenance callouts, security shifts, each with actual completion dates. The link from each invoice line to its source service record is what converts an efficient summary into an auditable compliance document. Up next, continuous supplies. Scenario 7 is continuous supplies, services or goods provided progressively over time with no single identifiable completion moment. Operating leases, rental agreements, construction progress billing under milestone contracts, managed services retainers, long-term consulting engagements, and ongoing maintenance contracts. The key rule, and you need to memorize this, is the tax point. VAT is due on the earlier of 1. The date payment is received, or 2. The date payment becomes contractually due. This differs from summary invoices. Continuous supplies have an ongoing contract structure where each invoice corresponds to a milestone or payment event. Mandatory fields include the tax point date, period or milestone description, contract reference, and the continuous supplies scenario code. The invoice must be issued no later than 14 days after the month in which the tax point falls. Early payment pulls the tax point forward. Late payment does not push it past the contractual due date. The due date remains the backstop. Industry examples will make this concrete. 3 industries where the payment-triggered tax point drives invoice timing. First, real estate. A DIFC landlord leases office space at 2.4 million dirhams per year, quarterly in advance. Q2 rent of 600,000 due April 1st, but the law firm tenant pays March 28th, 3 days early. Tax point, March 28th, the earlier of receipt and due date. The landlord declares VAT in the March return, not April. The tenant recovers in Q1, not Q2, a common mismatch query from the FTA. Second, construction. A main contractor certifies completion of a structural frame on March 15th and submits a 15 million dirham payment application, with contractual payment due April 15th. Tax point, March 15th, application date, earlier than the April due date. 750,000 VAT in the March return regardless of when payment arrives. Third, IT services. A 200,000 dirham monthly retainer due on the 1st. June payment arrives June 5th, late. Tax point, June 1st, the contractual due date, the backstop. Consistent late payment creates a consistent VAT cash flow gap. Free trade zones next. Scenario 8 is free trade zone, and you need to be precise here because the rules apply only to designated zones listed under Cabinet Decision 59 of 2017. Not every UAE free zone is a designated zone. JAFZA, KIZAD, DAFZA are. Many others are not. Within a DZ, treatment varies sharply by transaction type. Goods moved entirely within a DZ or between DZs, generally out of scope for UAE VAT. Goods moved from a DZ to UAE mainland. Treated as an import, the mainland recipient accounts for VAT under reverse charge as importer of record. Services provided in or from a DZ. Taxable at 5%, regardless of zone location. And that last point is the most penalized FTZ error in UAE VAT practice. Businesses in designated zones providing services to mainland clients are not exempt from charging 5% VAT. Zone location is irrelevant for services. Issuing a zero VAT invoice based on DZ status creates an underdeclaration of output VAT and denies the client's input VAT recovery. Examples next. 3 FTZ transactions with 3 different VAT treatments. First, logistics. A JAFZA operator sells electronics to another JAFZA-registered distributor. DZ to DZ. Out of scope. Commercial invoice with no VAT and the FTZ scenario code. Had the buyer been a Dubai mainland retailer, the goods would exit the DZ, trigger an import, and the retailer would account for VAT under reverse charge. The DZ boundary is the trigger. Second, manufacturing. A plastics manufacturer in KZN supplies industrial packaging to a mainland food manufacturer. Goods cross the DZ boundary into the mainland, treated as an import. The food manufacturer is the importer of record and accounts for VAT at 5% under reverse charge. Third, professional services. A DAFZA management consultancy provides operational strategy to a mainland logistics company. Despite DAFZA registration, this is a service, taxable at 5%. A standard tax invoice at 5% must be issued. Issue a zero VAT invoice based on zone status, and you have created an underdeclaration and denied your client's input VAT recovery. E-commerce next. Scenario 9 is e-commerce VAT-registered UAE suppliers making taxable supplies to consumers through websites, apps, and digital platforms. The headline obligation. Businesses whose annual e-commerce consumer supplies exceed 100 million dirhams must capture the consumer's delivery emirate and include it in the Pint AE invoice data. This enables the UAE government to distribute VAT revenue to each emirate based on where consumption occurs. Below the threshold, standard simplified invoice rules apply. Supplier TRN, issue date, description, total including VAT. No buyer TRN required. Above the threshold, all of the above plus the consumer delivery emirate derived from the delivery address. For B2B e-commerce, where the buyer has a TRN, a standard tax invoice with full fields applies regardless of channel. And here is the complexity for platform operators. Every transaction requires a determination. Are they a disclosed agent or the deemed supplier? Large marketplaces may operate multiple models simultaneously, each requiring correct scenario coding. Examples next. 3 e-commerce models with different invoice implications. First, a retail marketplace doing 800 million dirhams in consumer sales, well above the threshold. Every order captures the delivery emirate at checkout. Dubai is DXB, Sharjah is SHJ. The Pint AE invoice data includes the emirate field per transaction. Monthly ASP submissions aggregate emirate-level VAT distribution. Logistics API confirms the delivery emirate in real time before invoice generation. Second, food delivery, 180 million dirhams per year of consumer orders, also above threshold. The restaurant delivery location maps to an emirate, captured per order. For corporate accounts ordering on a company TRN, the system switches to standard tax invoices. Emirate capture still required, but invoice format changes. Third, SaaS subscriptions. A UAE HR software company at 2,000 dirhams per month per subscription. Business customers with TRN get standard tax invoices. E-commerce channel is irrelevant. Individual freelancers without TRN get simplified tax invoices. Below the consumer revenue threshold, no emirate capture. Once crossed, mandatory for all consumer accounts. Exports next. Scenario 10 is exports, supplies of goods or services to recipients outside the UAE. 0 rated with full input VAT recovery on all related costs. For goods exports, customs evidence, export declaration, bill of lading, or equivalent commercial proof is mandatory and must be obtained within 14 days of the supply date. For services exports, 2 conditions. The recipient must be outside the UAE, and the benefit of the service must be received outside the UAE. This second condition is where most disputes arise. Invoicing an overseas company for a service that is consumed inside the UAE does not qualify as a 0-rated export. It is a standard 5% supply. Mandatory fields include the 0% rate, the export basis, and the scenario code. Without evidence at audit, the The supply is reclassified at 5% and VAT plus penalties are recovered from the supplier. The place of consumption test for services. Training delivered to executives who travel to Dubai? 5%. Benefit received in UAE. Engineering design for a Riyadh building by a Dubai firm? 0 benefit received in KSA. The test is where the benefit is consumed, not where the invoice is sent. 3 export scenarios with different evidence and place of supply rules. First, manufacturing. A UAE packaging maker exports 4.5 million dirhams of corrugated boxes to a Saudi food manufacturer. UAE Customs generates an export declaration at the exit point. The zero-rated invoice references that declaration number. Everything is filed within 14 days. Input VAT on raw materials, energy, and logistics is recovered in full. Second, engineering services. A Dubai MEP firm designs HVAC and electrical systems for a Bahraini hospital. All work done in Dubai, but the benefit, the hospital, is in Bahrain. Zero-rated export service at 2.8 million. Evidence retained. Project contract specifying Bahrain location. Drawing delivery records. Client acceptance from Bahrain. Had they instead consulted on UAE health and safety compliance, that would be 5%. Benefit received in UAE. Third, logistics. A Jafza-based trader stores Chinese electronics in bonded storage and re-exports to Kenya. Goods bonded in Jafza, out of scope. On re-export, a zero-rated invoice to the Kenyan buyer references the bill of lading. Input VAT on UAE business costs is recovered. Margin scheme next. Scenario 11 is the margin scheme, used for second-hand goods, antiques, collector's items, and works of art purchased from a non-taxable person, where input VAT was not recoverable on the original purchase. VAT is calculated on the dealer's margin only, the difference between selling price and purchase price. The formula: VAT equals 5 divided by 105 times the margin. If the margin is 0 or negative, no VAT is due. The scheme prevents double taxation on goods where VAT was already borne in a prior consumer sale. Critical invoicing rule. VAT is not separately itemized on the invoice face. The total price is shown inclusive, with a statement that the margin scheme applies. The VAT content is calculated internally from the stock register, which must record purchase price, selling price, and margin for every item sold under the scheme. And the B2B restriction matters. Any business buyer purchasing under a margin scheme invoice cannot recover input VAT. The scheme is designed for final consumer sales. Examples next. 3 markets where margin scheme invoicing is the operating standard. First, automotive. A Dubai dealer buys a 3-year-old Land Cruiser from a private individual for 160,000 dirhams. No VAT on the private sale. Sells refurbished for 185,000. Margin: 25,000. VAT 5 over 105 times 25,000 equals 1,190 dirhams. Invoice shows the inclusive total with a margin scheme statement, no separate VAT line. Second, antiques and fine art. An auction house buys furniture from a private estate for 40,000, restores it, hammer price 95,000. Margin: 55,000. VAT 2,619. Private collector buyer cannot recover input VAT, which is appropriate, since the scheme is designed for final consumer sales. Third, electronics. An online reseller buys refurbished smartphones from individuals at 800 dirhams, sells at 1,100. Margin: 300 per unit. VAT 14 dirhams 29. Simplified margin scheme invoices with scheme notation. For business buyers wanting an input VAT claim, only possible if the original purchase was from a registered seller with UAE VAT. Self-billing next. Scenario 12 is self-billing. The buyer issues the tax invoice on behalf of the supplier. For conditions must be met. 1. A written self-billing agreement must be in place before any self-billed invoices are issued. 2. Both parties must be VAT registered. 3. The supplier must not issue duplicate invoices for the same supplies. 4. The buyer issues the invoice using the supplier's TRN as the supply party, with the buyer identified as the issuing entity. Common in scrap metal and recycling, where the buyer grades and prices the material. Agricultural produce purchasing, large retailer-to-supplier settlement programs, and content creator platforms where the platform knows the payment amount. The buyer transmits the TDD to the FTA via their ASP. The supplier declares the same supply in their VAT return based on the self-billed invoice they receive. No duplicate. Supplier obligations. Review and either accept or dispute through the agreed process. Declare output VAT for the period of the invoice. Retain a copy as their sales record. The self-billing agreement must specify the dispute resolution process. Examples next. 3 industries where self-billing is embedded in supply chain operations. First, scrap metal. A UAE steel recycler weighs incoming loads, determines the grade, and sets the price. Information the supplier does not hold. Weekly self-billed invoices. Supplier TRN as supply party. Recycler TRN as issuer. Suppliers declare output VAT. The recycler claims input VAT. Hundreds of transactions monthly, only possible with self-billing. Second, retail. A hypermarket runs a vendor settlement program. The hypermarket system calculates payments from confirmed deliveries, agreed prices, and promotional deductions. Weekly self-billed invoices reflect exactly what was received at what price. Suppliers avoid the burden of matching their invoice to receipt records. The hypermarket does it, the supplier confirms or disputes. Third, digital media. A platform commissions video content from 150 independent producers, knows view counts and per-view rates. Rather than receiving 150 invoices, the platform issues self-billed invoices based on platform-calculated earnings. VAT-registered creators declare output VAT. Non-registered creators below the threshold receive commercial payment notices instead. That completes the 12 tax invoice scenarios. Now Part 2, the commercial invoice. We now move to Scenario 13, the commercial invoice. This is a single, specialized document used for transactions that fall entirely outside the UAE VAT system. Not zero-rated, not exempt, out of scope, but, and this is the critical point, still reported through the ASP for traceability. The FTA wants visibility on every transaction in the economy, even those it does not tax. Let us see when this applies. Scenario 13 is the commercial invoice out of scope. Used for transactions outside the UAE VAT system entirely. Not zero-rated, not exempt, simply not a taxable supply under UAE VAT law. For main categories. 1. Intercompany transactions between branches or divisions of the same legal entity. Internal cost allocations and disbursements with no separate supply. 2. Transfers of a going concern, where FTA conditions are met, the sale of a whole business or an independent operating division. 3. Non-business activities by holding companies and sovereign government entities. 4. Certain transactions below the mandatory VAT registration threshold. The document type is commercial invoice. No VAT charged. The out-of-scope indicator set in Pint AE XML. Supplier TRN or TIN. Buyer details. The invoice must still be transmitted through the ASP and the TDD reported to the FTA. Out of scope does not mean unreported. For transfer of going concern, the business must be capable of operating independently, must be a going concern at transfer, and the buyer must intend to continue it. An FTA ruling should be sought before any significant business disposal. To GC cannot be self-assessed with confidence. 3 real-world out-of-scope transactions. First, banking. A UAE bank's Abu Dhabi head office allocates IT infrastructure, compliance, and HR support costs to its Dubai branch. Both are part of the same legal person. There is no separate supply, only an internal cost allocation. Commercial invoice, no VAT, still transmitted through the ASP for FTA reporting. The bank maintains internal recharge agreements to document the basis for both VAT and corporate tax purposes. Second, M&A. A UAE logistics company sells its entire freight forwarding division, vehicles, contracts, staff, premises, Goodwill, to a buyer who will continue operating it as a going concern. FTA conditions for TGC are met. Commercial invoice for 45 million dirhams consideration, no VAT. An FTA ruling confirmed the TGC status in advance, and individual assets that would not qualify as part of the going concern would attract standard VAT at 5% separately. Third, holding companies. Passive dividend income from operating subsidiaries. Not a supply for UAE VAT purposes. No invoice required for the dividend itself. But active management fees from the same holding company are a taxable supply at 5%, separately invoiced. The commercial invoice treatment applies only to passive income. Now Part 3, Credit Notes. That brings us to the final part, Scenarios 14 through 16, the Credit Notes. Credit notes reverse or amend a previously transmitted e-invoice. There are 3 variants, mirroring the structure of the underlying invoice. A standard credit note for ordinary tax invoices, a disclosed agent credit note for agent-billed transactions, and a self-billing credit note where the buyer issued the original invoice. In every case, the structural rule is the same. The credit note mirrors the original invoice exactly. Let us work through each. Scenario 14 is the standard tax credit note, issued by the original supplier to reverse or amend a previously transmitted tax invoice. For common triggers, goods returned by the buyer, a pricing error discovered after the invoice was transmitted, a post-supply discount or rebate agreed after the original supply, or a supply canceled after transmission. Critically, the credit note must reference the original invoice. Original invoice number and issue date are mandatory fields. The VAT adjustment flows to both sides. Supplier's output VAT reduced, buyer's input VAT reduced. In the period the credit note is issued, not retrospectively in the original invoice period. Document type code 381. Mandatory fields. Both TRNs, credit note number, issue date, reference to the original invoice, line items being credited at the original VAT rate, total credit amount, and the reason. And here is the timing rule that catches people out. VAT adjustment falls in the period the credit note is issued, not the period of the original invoice. The FTA's real-time TDD data will spot any attempt to use credit notes to artificially shift income between periods. Examples next. 3 common situations requiring a standard tax credit note. First, retail wholesale. A homewares distributor supplies 500 units to a supermarket in February for 150,000 plus 7,500 VAT. In March, 80 defective units are returned. The distributor issues a standard credit note in March, 24,000 net plus 1,200 VAT, referencing the February invoice. Both parties adjust their March returns. Neither amends February. Second, professional services. An IT consultancy invoices in January for 480,000 at 1,200 per hour. In February, the agreed rate is found to have been 1,100, a 40,000 overcharge. Credit note issued in February for 40,000 net plus 2,000 VAT. Both parties reflect the reduction in the February return. Third, construction. A fit-out contractor invoices 2.8 million in September. Following final snagging, a negotiated discount of 85,000 is agreed in November. Credit note in November for 85,000 plus 4,250 VAT, simultaneously resolving the commercial dispute and the VAT position. On to the disclosed agent credit note. Scenario 15 is the disclosed agent tax credit note issued by an agent on behalf of a principal to reverse or amend an original disclosed agent tax invoice from Scenario 5. The structure mirrors the original invoice exactly. Issued in the principal's name and TRN by the agent as disclosed issuer. Applies whenever goods are returned under an agent-facilitated sale. Pricing errors occurred on an agent-issued invoice. Post-supply discounts are agreed on agent-billed transactions, or a lease or platform-based transaction needs reversal. Both the principal's TRN and the agent's identity must appear on the credit note, exactly as they appeared on the original. The principal includes the VAT adjustment in their return. The agent does not, unless the credit relates specifically to the agent's commission, which is a separate taxable service. and no duplicate credit note may be issued by the principal for the same adjustment. Reconciliation discipline matters. The agent must reconcile all credit notes issued on behalf of each principal against the principal's records. Mismatches between the agent's records and the principal's VAT return are a common FTA audit query in agency billing structures. Examples next. 3 agency contexts where a credit note must mirror the original structure. First, real estate. A property manager issued disclosed agent invoices for Q1 rent to 30 tenants in the REIT's TRN. 2 tenants exercised break clauses and vacated mid-quarter. And used rent must be refunded. The manager issues disclosed agent credit notes in April. REIT's TRN as principal, management company as agent issuer, referencing the original March invoice. The REIT adjusts its April output VAT. The manager records the credits against tenant accounts, not against its own return. Second, travel. An OTA issued hotel room invoices in the hotel's name for a corporate travel account. 12 reservations canceled. The OTA issues disclosed agent credit notes carrying the hotel's TRN as principal, OTA as agent, for each refund. The hotels adjust their output VAT positions. The OTA processes refunds and records the credits against agency records, not its own output VAT return. Third, advertising. An agency placed advertising for an FMCG brand. The publisher discovers a technical error and issues a partial credit to the agency. The agency passes it through via a disclosed agent credit note. The brand receives a reduction in input VAT in the credit note period. Final scenario next. Scenario 16, our final scenario, is the self-billing tax credit note, abbreviated SBCN. Because the buyer issued the original self-billed invoice from scenario 12, the buyer must also issue the credit note, maintaining structural consistency. Triggers. Goods received under a self-billing arrangement fall below the invoice quantity or grade, weight discrepancy, quality rejection. A price correction is required after settlement, or a return of goods occurs. The supplier must not issue a separate credit note for the same adjustment. The buyer's SBCN is the only valid reversal document, and the self-billing agreement must explicitly cover credit note issuance, not just invoices. Mandatory fields. Document type 381, supplier TRN as supply party, buyer TRN as issuing entity, the self-billed credit note scenario code, reference to the original self-billed invoice, line items at the applicable VAT rate. The supplier acknowledges the SBCN, reduces output VAT in the same period the buyer reduces input VAT, and retains a copy as a purchase return record. Many self-billing agreements omit the credit note clause. Review yours and update if necessary. Final examples next. 3 situations where the buyer must issue the credit note. First, scrap metal. A recycler self-billed a supplier for 50 tons of copper-grade scrap at $8,500 per ton, $425,000 plus VAT. After lab analysis, 12 tons are reclassified to a lower grade at $6,200 per ton. Price reduction, $27,600. The recycler issues a self-billing credit note for $27,600 plus $1,380 VAT, referencing the original. The supplier does not issue any separate document. Second, retail. A hypermarket self-billed a food supplier $1.2 million for January deliveries. In February, a service level audit identifies a 2% shortfall, $24,000 performance deduction. SBCN issued in February for $24,000 plus $1,200 VAT. Both parties reflect the credit in their February returns. Third, agricultural produce. A date processor self-billed a palm farm for 5,000 kilos of medjool dates at 35 dirhams per kilo, 0 rated. Factory reweighing shows 4,820 kilos, a 180 kilo shortfall. SBCN issued for 6,300 dirhams at 0% VAT. Still required for accurate quantity reporting, despite no VAT impact. And that completes all 16 scenarios. Thank you for working through this guide. Keep it open as your operational reference whenever a real-world scenario lands on your desk. 3 situations where the buyer must issue the credit note. First, scrap metal. A recycler self-billed a supplier for 50 tons of copper-grade scrap at $8,500 per ton, $425,000 plus VAT. After lab analysis, 12 tons are reclassified to a lower grade at $6,200 per ton. Price reduction, $27,600. The recycler issues a self-billing credit note for $27,600 plus $1,380 VAT, referencing the original. The supplier does not issue any separate document. Second, retail. A hypermarket self-billed a food supplier $1.2 million for January deliveries. In February, a service level audit identifies a 2% shortfall, $24,000 performance deduction. SBCN issued in February for $24,000 plus $1,200 VAT. Both parties reflect the credit in their February returns. Third, agricultural produce. A date processor self-billed a palm farm for 5,000 kilos of medjool dates at 35 dirhams per kilo, zero rated. Factory reweighing shows 4,820 kilos, a 180 kilo shortfall. SBCN issued for 6,300 dirhams at 0% VAT, still required for accurate quantity reporting, despite no VAT impact. And that completes all 16 scenarios. Thank you for working through this guide. Keep it open as your operational reference whenever a real-world scenario lands on your desk.